everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chan, a chartered professional accountant located in Toronto, Ontario, Canada. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is turning your primary residence mortgage that's non-tax deductible into a tax deductible machine. But before I get started, make sure you give us a thumbs up if you like our video, and make sure you also hit the subscribe button if you want to stay on top of the latest tax tips and investment advice as well. So now with that, let's get started. A while ago, I've done a YouTube video and a blog post specifically on 5 steps on turning your primary residence mortgage that's non-tax deductible into a tax deduction machine. You can always refer back to this particular video in terms of how you can implement the whole process. Now, one of the viewer was asking me, hey, Cherry, that video was done 2 years ago. Would you be able to do an analysis on whether you should be still applying the same 5 steps when it is in such a high interest rate environment? And as a matter of fact, we've done some analysis for all of you. With that, let's get started. Okay, as most of you would have known already, in Canada, you are not allowed to deduct the primary residence mortgage interest against your income, unlike in the United States. The main reason is because primary residence is the only asset other than TFSA account that you invest in, and when you sell the property and make a capital gain, you would not be subject to any capital gain tax. And because of the non-taxable nature of primary residence, therefore the interest incurred on borrowing to purchase your primary residence is not tax deductible, generally speaking. Now, just because the mortgage interest is non-tax deductible doesn't mean that we cannot somehow use it to turn it into a tax deduction machine. And because of its non-tax deductible nature, with the primary residence mortgage interest, the cost of owning primary residence is actually quite high. Now, a lot of you are asking me the questions, is it worthwhile to do this, apply this 5-step process that I mentioned in the other video? One of the 5-step process is that you would leverage your home equity line of credit. So borrow against your line of credit that's attached to your primary residence, and use that amount, use that home equity line of credit to pay off the expenses on your rental investment property. And if you do that, that means you're now carrying a debt in your HELOC, home equity line of credit. And as you all know, majority of the home equity line of credit would have a variable interest component. And today's variable interest rate, at least on my home equity line of credit, is at 7.45% as per Scotiabank. So I'm using 7.45% for comparison. Some of you may start off having your primary residence mortgage committed at 2.94%, so a fixed rate mortgage to begin with. And if you apply the 5-step process in the other video that I mentioned, now you're converting a fixed rate mortgage at 2.94% into a variable rate home equity line of credit at 7.45%. So we're talking about 3%, 7.4, at least 3.5% delta in terms of interest rate that you have to pay. You are wondering if this is something that you should be doing. Well, here is the thing. We did the calculation for the next 5 years. The truth is that if you look beyond 5 years, chances are your mortgage term will expire within the next 5 years. It's not worth to talk anything beyond the 5 years. I've actually done analysis for the entire term for 30 years, but it's just not worth it to look beyond the 5-year term. Your 2.94% fixed rate mortgage would expire within the next 5 years regardless. Mine is expiring fairly soon, sometime next year. So I'm just doing the presentation, the analysis right now based on the next 5 year that you would still be entitled to 2.94% low interest rate mortgage. Now, with that, let's look at our spreadsheet and analysis. Now, assuming that your mortgage at the beginning is $750,000 and you have a fixed rate mortgage of 2.94%. Now, you also invest in a rental property, and that rental property generates $4,000 rental income on a monthly basis. Now, so on an annual basis, you are generating about $48,000 of rental income. Now, If you do nothing, every single year you'll have to pay the mortgage payment, and you will have a large balance of mortgage outstanding at the end of the year. Every year, year one, you will have $22,000 of interest that's not tax deductible. Year two, you will cumulatively you will have $43,000 of interest that's not tax deductible, and so on and so forth. By year five, you would have accumulated $104,000 of non-tax deductible interest on your primary residence mortgage. And you still have a balance of $666,000 roughly left on your primary residence mortgage. Now, but instead of doing this, instead of leaving it on and do nothing with your primary residence mortgage, we apply the 5-step process that we mentioned in the other video. So you take the $48,000 of rental income and you use it to the prepayment function available with your primary residence mortgage, and you apply that $48,000 into your primary residence mortgage prepayment on a monthly basis, and draw out from your line of credit $48,000, the same amount of $48,000, and you use the $48,000 from your line of credit for the purpose of paying off your rental expenses, and thus converting your debt from a non-tax deductible mortgage to something that is tax deductible. At least a portion of it is tax deductible. So by doing this process, by implementing the 5-step process, you would now be able to convert a portion of your primary residence mortgage into a tax deductible mortgage. Note that after you apply the in year one, after you apply the 5 steps on a monthly basis, your total debt outstanding at the end of the year is $733,000. Whereas if you don't apply the process, your debt outstanding is still $734,000. The only difference is that out of the $733,000 debt after you apply the 5-step process, $48,000 interest on that $48,000 is tax deductible. Interest on $685,000 is not tax deductible. Now, by applying this process, obviously, you're now incurring interest on $48,000 on your line of credit interest. And this $48,000 at 7.45% interest rate, you would incur $1,937 on the line of credit interest. If your marginal tax rate is at 40%, you would be able to deduct this $1,937 and get a tax saving of $775 on your personal tax return. Therefore, when we look at your net after-tax cost from converting this rental income by applying the 5-step process, you would be incurring $1,162 of after-tax interest on your line of credit. Now, but you would also be saving some interest costs as non-deductible interest because if you did not apply the 5-step process, then you would have incurred $22,000 of $21,705 of non-deductible interest. But if you had applied the process by applying the $48,000 rental income and pay off your primary residence more, now all of a sudden your non-deductible interest is lower to $21,057. So you have an interest saving of $648. So $21,705 if you do nothing, minus $21,057 if you apply $48,000 of rental income, apply the 5-step process. And you would have an interest saving of $648 in year one. Although you incur the cost of $1,162, you can see that it incur for year one at the end of year one. You are actually not saving money, you're actually incurring a cost by applying this process. But you don't stop there. You look at year two. Now, year two, assuming you still have this 2.94% fixed rate mortgage, and we assume it for the next 5 years. In year two, by year two, if you had done nothing, you don't apply the 5-step process, you would have incurred roughly about $43,000 of non-deductible interest on your primary residence. That's cumulative, so year one and year two combined. Now, but if you did, you continue to apply the same principle, the 5-step process to turn your mortgage, primary residence mortgage, into a tax deduction machine, then your cumulative non-deductible interest by year 2 would be lower to $40,000. So $40,000 versus $43,000, already you're ahead by $2,700. Now, but you also, unfortunately, you're now drawing more money from your line of credit to pay for your rental expenses. Now you have higher interest related to your line of credit balance. So by year 2, you would have incurred $5,500 of additional line of credit interest that you would not otherwise need to incur. And the tax saving on it is cumulatively about $2,205. And so your net tax cost is $3,308 from the interest incurred on your line of credit. Now, cumulatively, for both years combined, you would have a net cost after tax at $571. So you're still losing money in year 2, but you're losing less because year 1 you lost $514. By year 2, cumulatively combined year 1 and year 2, you only lost about additional $60 or so. So you're losing less money. By year 3, applying the same process, if you've done nothing, by year 3, you would have incurred $64,000 of non-deductible interest. But if you continue to apply the $48,000 rental income to pay off your primary residence mortgage, your cumulative non-deductible interest would have been $57,000. $67,000 compared to $64,000, you would have an interest saving of about $6,000, $6,300. And again, now that you've applied the same process for 3 years, so by the end of the 3rd year, the line of credit interest balance outstanding would have been increased to $144,000. Now, at $144,000, the additional line of credit interest that you would have to pay is about $9,000 by now, cumulatively, all 3 years combined. And the tax saving from all 3 years of interest would be $3,636. The after-tax cost of interest on line of credit would be $5,453. And so the net cumulative saving by year 3, you would be ahead by $856. So what it really means is that it does make a difference. And the tax saving by year 3, cumulatively, not tax saving, by year 3, the net saving would have been $856. So by year 3, you would be ahead. Even in current variable line of credit at 7.45% rate, you would still be ahead by year 3. Now, by year 5, just skip ahead by year 5, if you have done nothing, didn't apply the 5-step process that I mentioned in the other video, you would have incurred $104,000 of non-deductible interest on your primary residence. But by continuing to apply the same process, by the end of year 5, you would have only incurred $85,000, $86,000 of non-deductible interest. But now your line of credit balance is increased to $240,000. So at the end, your net saving by year 5 would have been $8,337. So you're ahead by $8,337 by year 5. This is taking into account that, hey, like you're applying this process, if you look at by the end of year 5, if you had done nothing, you would still have $666,000 of primary residence mortgage outstanding. But if you've done something, you've applied this process continuously, by year 5, your balance outstanding on your primary residence mortgage would have been only $408,000. So you're already ahead by $342,000. In addition to that, I know you're carrying a line of credit balance now, but the line of credit balance combined with your primary residence mortgage, your actual amount outstanding, your debt outstanding, is $648,000. So compared to $666,000 if you've done nothing, you're actually ahead. The reason is because a larger portion of your mortgage payment, as you apply the 5-step process, you pay your mortgage down with your rental income on a regular basis, on a monthly basis. the interest, the amortization calculation is different. A larger portion of your mortgage payment is allocated to paying down your mortgage principal, and a lesser amount is being allocated to interest because your balance is being paid down a lot faster. So this totally makes sense. It's still worth it if you have a low fixed rate mortgage and your line of credit is a lot higher interest in terms of the line of credit. Now, but what if you are like me, you are stuck with the variable interest rate on your primary residence mortgage? What would happen? If you are like me, who's stuck with this variable mortgage interest, my variable mortgage rate is at 6.43%. It's prime minus a spread. Yours may be the same way as well. So if you look at my spreadsheet here, we did the exact same analysis, except that from day one, from year one, you are having a variable mortgage and your rate is at 6.43%. From year one, you already have a net saving of $259. And by year 5, you would have a cumulative net saving of about $19,000. So that's pretty awesome. By year 5, you would have a net saving of $19,000, a lot more than about $10,000 more than the fixed rate mortgage that the analysis that we had done. So you are still way more ahead. And if you compare the mortgage left at the end of the 5th year, you would have $700,000, $101,000 left if you haven't done anything to apply the 5-step process to turn your primary residence mortgage into a tax deduction machine. You would have $701,000 left on your primary residence outstanding. But by the end of the 5th year, if you apply the process, you would only have $419,000 left. We're talking about huge delta. And the combine of the line of credit that you owe to the bank for investment purpose, you would be left with $659,000 of total debt compared to $700,000. So this whole 5-step process is not just here to help you to turn your mortgage interest into a tax deductible machine. It's actually helping you to pay off your mortgage a lot faster. So if you haven't applied the process and you still have questions and doubts, you should really start right now. And make sure that you visit the other video on the 5 steps that you need to look at. And you may also want to visit our website, our blog post on the 5 steps that you would be able to apply to help you save on taxes as well as paying off your mortgage a lot faster. Now, if you like our video, make sure that you give us a thumbs up and hit the subscribe button below. If you find this video useful, make sure you share with your friends, families, especially those who still owe money on their primary residence mortgage and they are non-deductible. They're not using this process to help them to get ahead in their lives. Until next time, happy Canadian real estate investing.